Let me get Michael O'Sullivan in. He's head of global asset allocation and research at Credit Suisse Private Bank, joining me from London. Michael, very good morning to you. Thanks so much for taking our call. Let me just first get a broad thought from you on developed equity markets right now. Are they positioned for continuing gains? About a month or so, people were talking about a short-term correction being possible. I don't know whether you still hold that view.
I think a lot of the fundamental indicators are, how would I say, being left behind by the market valuations, earnings momentum, not that attractive. And it really seems like this is a classic liquidity-driven rally. We had strong moves earlier in the week. In part, they have, I think, closed out a lot of short positions and maybe contributed to more impatience on the part of people who hold cash. So I think for the moment it looks like it's something of one-way traffic, but we are getting to levels, I think, that some of the investors who have gotten into the market, let's say later last year, must be thinking about taking profits.
What is the kind of asset allocation strategy that you're pursuing right now? Equities versus other asset classes, and then within equities, developed versus emerging?
Yeah, on a strategic basis, we have for the last couple of years actually favoured equities over bonds, and we're not changing that on a long-term or strategic basis. That remains in very much in place. And I think even while the short-term moves in markets are maybe a little bit harder to gauge, the longer-term, I think, picture for equities, provided that this year we really do get back on track to a global economic recovery, I think that's a much easier picture to follow.
Which brings me to some more immediate triggers. The US jobs number, I guess, would be of all important attention this later today. What are you expecting? Do you continue to see gains in terms of job additions on the farm non-farm payroll side?
Continue to see gains, but I think likely not gains that are not yet grand enough to really make big inroads into unemployment levels in the US. And actually, in the last couple of months, it's still been people leaving the jobs market that have helped to bring the unemployment rate down. Now, having said that, a lot of the macro data we've had in the last week, the two ISM numbers, the ADP hiring number, have been quite strong. So I think this number might actually surprise a bit to the upside. But I think a lot of that at this stage is probably in the price.
Okay, 160,000 is what Reuters is forecasting, just for our viewers. Michael, what did you read into the ECB chief's comments yesterday? I think the euro rebounded post that because the market positioning was expecting sort of dovish comments from the ECB chief indicating rate cuts maybe in the next couple of months. That didn't really come through, though.
It didn't really come through, and the only thing that would have maybe pointed towards that was the fact that the inflation forecast of the ECB is still quite low. Now, having said that, the Eurozone growth numbers were also revised down lower to about minus 0.5%. So in terms of at least of how the ECB reads the European economy, it's still from actually quite a pessimistic perspective in terms of growth. And actually, if you look at the big European countries, Italy, France, Spain, they really are still struggling. Europe remains the weakest zone globally in terms of its economic performance.
Just sort of the third big economy that everybody is watching, China. Have you been tracking the data there? And the export numbers, at least out of China, look good. And given their sort of reliance on exports, given the importance of exports to their economy, that should be beneficial. Although this time the import numbers will actually lower, but there could be seasonal factors at play there.
I think China is interesting because there are conflicting signals opening up, and if you look at the commodity markets, the commodity markets really have lagged the rally in global equities. Emerging market equities, not just China but also Brazil, have lagged as well. So I'm detecting the fact that commodity markets not quite yet buying into the resurgent China growth story, and also I think risk appetite in Asia is not as hot as it is in the developed world.
All All right, I'm going to leave it at that, Michael. Thanks so much for your quick views on some of those event-based questions, including the ECB meet, the jobs data later today from the US, China data, but more broadly, they remain positive on equities, and you've been seeing that move up on global equities.